Hey, welcome back everybody. In this video I have two objectives. One is to talk through each financial statement and give you an idea of how these are constructed and how certain concepts that you've learned in class actually start to culminate in these financial statements. And then secondly, the bigger thing that I want to accomplish is to explain to you how these financial statements are actually interrelated so that you can actually see that on the screen. To begin with, there's a video that I've done that is about a set of books, and that set of books video talks about how the chart of accounts will dictate what classification an account will be tied to. For example, an account could be set up and it might be classified as a revenue account, or it's classified as an expense account, or it's classified as an asset account. You get the picture here. That classification will determine if the account goes to the income statement or the balance sheet. The important thing to remember here is that the two primary financial statements that spawn everything else is the income statement and the balance sheet. And I'll show you what I mean by that in a moment. So let's take a look here at an income statement. So you can see here that the only types of accounts that are shown on the income statement are revenues and expenses. So any account in the chart of accounts that's actually associated and classified as a revenue or an expense account would show up on the income statement. Assets will not be here, liabilities will not be here, and stockholder equity accounts will not be here. So basically this is the money coming in from sales of product or services and the expenses associated with those sales. And hopefully at the end of a period you will end up with that lovely net income number down there. Now let's take a look here at the statement of retained earnings. Now the reason that I say that a statement of retained earnings is not necessarily a primary financial statement is because it actually depends upon the income statement actually being created and completed. Our statement of retained earnings is pretty straightforward. I mean, this is pretty much all there is on here. It has a beginning retained earnings balance. You add in whatever net income or net loss. Okay, so if you've got a net loss, you would subtract it. And then you subtract any dividends that are paid. And that is leads to your retained earnings balance at the end of that period. The important thing to note here is the net income or loss from the income statement actually transfers over to your statement of retained earnings. So if you had a net loss on your income statement, then you would be subtracting that net loss on your retained earnings statement. But that is the relationship between those two statements. Next, the statement of cash flow is basically a reconciliation of the cash account, and I'll show you that here in a moment. But your statement of cash flow is basically saying how did we generate cash and how did we use cash in our business. And there are three different distinct ways that we can generate or use cash. One of them is operating activities. And you can see here that there are various different operating activities, and all this relates to is the everyday, day-to-day running of your business. It's what you do to actually generate cash and use cash. So if you pay salaries, if you pay rent, if you get cash from your customers, all that sort of stuff, those are all operating activities. The second way that you can use or generate cash is in investing activities, and that's where you are investing in different assets, or you may be investing your money in stocks or some sort of interest-bearing account or something like that at a bank. There could be various different ways that you're generating or using cash through investing. And then finally, financing activities are where you could be, like you see there, you might be paying dividends to your stockholders. You could also be getting money into your business because you've actually gone to the bank and gotten a loan. That's a plausible situation. So financing activities is basically where you are possibly financing yourself and financing some debt with somebody. And therefore, you'll see down at the bottom of this cash flow statement that the cash at the beginning or at the end of a period and the beginning of a period, you should be able to reconcile this to the balance sheet, which leads us to finally looking at the balance sheet. And so on our balance sheet, you can see this only has assets, liabilities, and stockholder equity. And therefore, we are keeping track of the long-term financial decisions of the business. And to me, the balance sheet is probably one of the more important financial statements, I think, only because it does tell us that over time, how the company has used its financial resources. Of course, all of these are important. All of these financial statements are important, and taken collectively, they can give you a really good idea of how a business makes decisions, makes financial decisions, and runs their business. The important thing to note is that on your statement of cash flow, your cash December 31st is the same as your cash on the December 31st balance sheet. So this is important to see how that relationship works. So basically, your cash flow statement is a reconciliation of how you have come to this balance each and every month for the cash account on your balance sheet. And then finally, your retained earnings from that retained earnings statement should be exactly the same as the retained earnings balance that's in the stockholder equity portion of the balance sheet. So therefore, each month, to recap, each month, those chart of accounts will drive, okay, this account needs to be represented on the income statement versus another account needs to be represented on the balance sheet. The statement of cash flow and the statement of retained earnings are just a little bit more detail on certain pieces of these pieces of information that actually exist on the balance sheet or the income statement. So I hope that helps. If you have any questions at all about these interrelationships, please leave a comment below, and I look forward to helping you and talking to you on another video. Thank you.